welcome to Investors Guide. We have a packed show lined up for you today. We're going to continue answering your questions and planning your portfolios. Now, speaking of that, you can write to us. There's an email ID at the bottom of your screen. Before I bring in Dhirendra Kumar and we start talking about your investments and your portfolios, let's see what we have lined up in the next half hour. Can you create wealth by using just mutual funds in the long term? Find out which funds you should be investing in. We'll also review the Franklin India Blue Chip Fund, and is the National Savings Certificate the best tax-saving instrument available to you? Find out later on the show. Let me introduce Dhirendra Kumar, the special guest on this show every week. Dhirendra, thank you so much for joining us on Investors Guide. Let's get straight to our portfolio versus portfolio section. Well, Sumit Chaudhary has written in, he's 37 years old and he tells us he works for a private company. He makes 1 lakh rupees a month. Now, he hasn't invested in ULIPs or shares, but he has a few mutual fund investments. And he wants to know, first of all, if the funds that he's invested in are the best funds to create wealth in the long term. He also wants to know what will happen if he stops his SIP midway. Will he be charged anything? Will he have to pay a fee? And he sent us a list of his investments. He has invested in 2 sets of funds. One started last year and the other one started this year. Birla Sun Life Frontline Equity, HDFC BlackRock Top 100, HDFC Top 200, Sundaram Select Focus Growth. Now, this is the fund that's giving him negative returns. He wants to know if he can stop that SIP. And Templeton India Growth Fund. These are the funds that he started SIPs in last year. He's also invested in a couple of funds this year, HDFC Equity, IDFC Premier Equity Plan A, and Fidelity Equity. There's also a couple of tax savers that he's invested in. He tells us he attempted to get a term insurance plan, but he was turned down because of bad health. At 37, that might be a bit of a concern. When you look at his portfolio right now, any changes that you would recommend by first glance?
No, I would not recommend too many changes. In fact, this portfolio, if he knocks Sundaram Select Focus, that is all the tuning it requires. And maybe, the other change could be the amount going into HDFC Top 200 should be invested in HDFC Equity itself. So that will actually, eliminate the need to track another fund, and he will get the same fund management, maybe superior experience over a period of time. And given his age at 37, where he has been denied for the term cover, I think that is more important. That comes ahead of he needs to buy a reasonable risk cover for his family, and he should try out other insurance company as well if he's denied by one company. And looking at his mutual fund portfolio, it reasonably resembles our aggressive portfolio or growth portfolio if you look at the combination of the two. And I would say very few changes, and he's on track.
All right, a few changes there that you need to make. Then he obviously asked that question that if he were to stop the SIP that's running right now into Sundaram Select Focus Growth, would he have to pay a charge? And also my next question is, up till now he's invested about 8,000 rupees into this company. There's not going to be short-term capital gains tax because there haven't been any gains. But where would you recommend he moves that 8,000 rupees into which fund right now?
I would suggest that, that money moves into Templeton India Growth Fund or, Fidelity Equity Fund, because if he is shifting his money from HDFC Top 200 to HDFC Equity, that will be a reasonably tilted investment. So one of these two funds. And he will be charged. Normally there is a 1% exit load for investment made and redeemed within 1 year. So 1% of the worth of the money will be charged by way of exit load. And if there is any capital gains, then he'll be liable for the short-term capital gains liability, which looks unlikely that he will have any.
Right, so that's the answer. Your mutual fund investments seem largely on track. You don't have to make too many changes there. But the worrying point is, of course, your lack of life insurance. You might, like Dhirendra suggests, want to look at a couple of other insurance companies to see if you can get a cover from one of them. And, of course, try and bring down the extent of your cover. A smaller cover might be easier to get for you right now. See what you can do, because you need an insurance cover, especially if you're supporting a family, right? Back to us if you need help with your insurance policy. Let's move on now to our hold or sell segment. S.H. Shah has written in, he's 62 years old and he tells us he made a lump sum investment into a few mutual funds. And he wants to know which of these he should hold or sell. He's obviously a retired person. He sent us a list of the funds. The first couple of funds are two balanced funds from the HDFC Group. I'm going to take them together. The HDFC Balanced and the HDFC Prudence Fund. Does he need both of them, or would you recommend he consolidate into one of them?
I would suggest that, he should be either one of them, and for somebody like him, HDFC Balance will be a superior thing, because HDFC Prudence on occasion turns out to be, looks so much like an equity fund. and we are getting into a bad weather where it will once again start looking like one. So I would suggest HDFC Balance for him.
10 funds that he's invested in, 5 of those funds are from the HDFC group, and they're all very different funds. They're not technically funds that suit someone who's 62 years old or who's retired. The next fund on his list is this HDFC Capital Builder Fund. Should he continue investing in this fund?
It's a good fund, but having 5 of them doesn't help. And if he's having HDFC Balanced or HDFC Prudence, he's getting a reasonable, basically, he should look at it that why he is buying a fund. And a part of his money goes into equity, a part of his money goes into debt when he chooses a balanced fund. And HDFC Capital Builder is a different approach, but it doesn't help. There's a reasonable complementarity. And I would suggest that he can do without all these funds for his profile and his age.
Okay, so without all of these funds, so I'm assuming HDFC Long-Term Advantage and Mid-Cap Opportunities, you're putting a redeem on both of these, so he should be selling both of these funds?
Yes, in fact, HDFC Mid-Cap Opportunity could be extremely disappointing for a person of his age. And of course, this is an excellent mid-cap fund. But should he have one? I think, somebody needs to somebody should have guided him about his choices a little more carefully.
All right, so what we have right now, Mr. Shah, is the 5 funds from HDFC that you have right now. You need to consolidate all of that into HDFC Balance Fund. You need to only have one fund from that fund group. That will be enough for you. The next fund on his list is the Reliance Equity Fund. Continue investing in this one?
This is once again a large cap fund, an average fund, and a not, one can't say by any, measure that it's an impressive fund. So purely for it being a mediocre fund, he should get out of this.
The UTI Mid-Cap Dividend is the next one on his list. Another mid-cap fund could cause him more heartache at a time like this. Should he possibly redeem the money from this fund?
Yeah, even this one. And I think, a mid-cap fund, it's an above average mid-cap fund. But does it fit into his portfolio? And is it a good time to get out of it? I think so.
So this is, the next one is a sector fund, and it's a sector fund that the sector has not been doing too well over the last couple of weeks. The UTI Banking Sector Fund. First of all, a sector fund in a portfolio like this, and secondly, a banking sector fund. Would you recommend he has this?
No, this is an urgent sell. This is a fund where he should get out of it. In fact, maybe it is a little late, but still it is it should be an important sell because one, he doesn't require a sector fund. The other, the outlook of this sector has suddenly turned very bleak.
The next one on his list is also a sector fund, the UTI Infrastructure Fund. Will it hang on to this one?
No, this one again, all the infrastructure funds are proving to be a big test of patience for investors. Anybody who came in the past 3-4 years, they have been extremely disappointed. I don't know when it will turn around. And I think, given that the politics and the global, the kind of weather we are in the market, I don't know when it will turn around. And he is not deprived of anything if he's getting into a generic fund. So I would say get out of it.
And the last one is UTI Top 100. Now, this is a large cap fund, but would you recommend this fund among the other options available in the market? We've asked him to right now sell most of his portfolio. Would you recommend really that he picks one of our, designed portfolios instead?
Yeah, I think so. And in fact, he has made all these investments lump sum. And I would say that all the money which he's redeeming, he should just carefully redeem it. Otherwise, just for the sake of redeeming it, he'll be down by 1%. I would say for him a growth with stability. From this money he is not expecting any periodic income with conformity, then he should go for our growth with stability or a little more conservative portfolio and spread his investment, make his investment over the next 6 months to 12 months. He should not take the money out and invest tomorrow. That I think is crucial.
Alright, so that's the advice going out to you, Mr. Shah. You need to redeem the money from that. There is a portfolio that we've designed for someone in your age group. That's flashing on your screen. Right back to us if you need anything else. Today, there is one more question that's come in from Mr. S.K. Goel. He writes in saying he's 69 years old. He currently has PPF, monthly income schemes, and stocks that he's invested in, mainly through IPOs. He also has some mutual funds. Now, he tells us he has 10 lakh rupees in his bank account, and he's been advised to invest that money in the Canara Robeco Indigo Fund. He wants to know, does that make sense, or are there better options out there for him?
No, that does not make sense. There are many better options. And more importantly, for a 69-year-old, being persuaded to invest in Canara Robeco Indigo Fund. Canara Robeco Indigo Fund it could be a reasonable fund. But the key thing is that, why does he need this? Why he needs to get into equity, first of all. The other is what is expectation. And will he be able to withstand a 5% decline in value? If the answer is no, he should not get into these investments. So my approach will be, if he is uncomfortable with any intermittent decline, he should not consider any investment in equity or a mutual fund. If he has to, but it is important for an old person to be investing in equity to beat inflation over a period of time, or maybe protect the value of his net worth, financial net worth. He should choose one or two good balanced funds, maybe something from our stable growth portfolio, and spread his money, not invest lump sum. Spread his 10 lakh over the next 10 months, 6 months to 12 months, and he should be okay.
All right, Mr. Goyal. Remember, Canara Robeco Indigo is not the best option for your 10 lakh rupees. Try and stagger your investments over the next 1 year to bring down your risk when investing in the market. Write back to us if you need anything else. Remember, if you have questions for Dhirendra Kumar, you can write to us on the email ID at the bottom of your screen. We're going to step into a quick break. On the other side, Dhirendra staying with us. We're talking about the Franklin India Blue Chip Fund. We'll find out if that's the fund you should be investing in right now. Don't go anywhere.